You're busy, right? You want to understand what's important, get the key information, without getting lost in just a mountain of details.
Exactly. And that's what we're here for today.
We're taking a close look at Indian Oil Corporation Ltd, IOCL.
That's right, their latest financial results for the year and the quarter ending March 31st, 2025.
And we've gone through, well, quite a bit of material. The investor handout, the full audited results.
Yeah, briefing documents, even a study guide they put out, gives you different angles.
So our mission really is clarity. Cut through the noise and give you the essentials on IOCL's performance.
Okay, let's jump straight in. The bottom line, standalone net profit after tax for the full year ending March 25, 12,961.57 crore.
12,961 crore. Okay. And for the last quarter.
For just Q4, it was 7,264.85 crore.
Right. But the big comparison is year on year, isn't it?
Absolutely. And that's where it gets interesting. The previous year, their standalone net profit was, wait for it, 39,618.84 crore.
Wow. Okay. 39,000 down to under 13,000. That's quite a drop.
It really is a significant decrease. And you see a similar picture on the consolidated side, too. For the year, consolidated net profit attributable to the parent was 13,507.84 crore.
So down significantly across both standalone and consolidated figures.
Exactly. Now let's look at the top line revenue. Standalone revenue from operations for the year was 8,045,512.61 crore.
Still a huge number, 8,45,000 crore.
Massive. But actually slightly down from the previous year's 8,666,345.38 crore.
Okay, so revenue dipped a little bit, maybe what, 2%-ish?
Roughly.
But the profit fell much, much more sharply.
Precisely. That points towards pressure on their margins, doesn't it? Less profit extracted from slightly lower sales.
It certainly does. So what's the main factor driving that margin pressure? Usually for refiners, it comes down to GRM, right?
You got it. Gross refining margin. And for the year April 24 to March 25, IOCL's average GRM on a standalone basis was $4.80 per barrel.
$4.80 per barrel. How does that stack up?
Well, here's the kicker. The previous financial year, that same figure was $12.05 per barrel.
Okay, wow. From over $12 down to under $5. That explains a lot about the profit drop.
It really does.
Yeah.
That's a substantial decrease in how much they make from refining each barrel of crude. Even the core GRM, which strips out inventory effects, was only $4.53 per barrel. So the core operation felt the squeeze.
Right, so the profitability of just turning crude into fuel took a major hit. Okay, despite tighter margins, how were things looking operationally? Were they busy?
Oh, incredibly busy. Their refinery throughput was 185 million metric tons. And get this, their capacity utilization was 107.1%.
Whoa, hang on. Over 100%, 107% capacity utilization. How does that even work?
It means they were running flat out, likely pushing beyond the standard nameplate capacity. It speaks volumes about efficiency, maybe strong demand.
But is that sustainable, running equipment that hard for long periods?
That's the key question, isn't it? High utilization is great for output now, but it could mean higher maintenance costs or potential stress on the assets down the line. It's definitely something to watch.
Makes sense. What else stood out operationally?
Their distillate yield, that's the percentage of higher value products like diesel, was decent at 79.7%, and fuel and loss was 8.6%. Their pipelines were busy too, moving 25.8 million metric tons.
Okay, so they're refining efficiently and moving product. What about sales? Selling the fuel.
And domestic sales, inland sales, were 21.867 million metric tons for the year.
And the breakdown, or the big sellers.
Diesel, HSD, was the largest chunk at 9.320 MMT. Then LPG at 3.881 MMT, and petrol, or MS, at 3.869 MMT.
So diesel is still king.
By quite a margin, yes. And if you add in exports, their total petroleum product sales hit 23.193 million metric tons. So still moving very large volumes.
Okay, big volumes, but as we saw, much lower margins hitting bottom line. Let's pivot to the balance sheet. How's their financial structure looking? Debt.
All right. As of March 31st, 2025, their standalone total borrowings were 134,465.54 crore.
About 1,34,000 crore in debt. And how does that relate to their equity, the debt-to-equity ratio?
That ratio came in at 0.75 times. on a standalone basis.
Okay, 0.75. For listeners who aren't accountants, what does that signal? Is that high, low, average?
It's generally considered pretty reasonable. Basically, for every rupee of shareholder equity, they have about 75 pays of debt. It suggests they aren't excessively leveraged. It's a fairly balanced funding mix.
And the total equity itself?
Standalone total equity stood at 178,676.86 crore, a substantial equity base.
Got it. Now, something investors always look for, dividends. Any news on that front?
Yes, there is. The board recommended a final dividend of 30%. That translates to 3.00 per equity share, assuming a face value of €10 per share. This is for the financial year 2024-25.
3 rupees per share, but it's just recommended for now.
That's right. It still needs the shareholders' okay at the annual general meeting. If they approve it, the payout should happen within 30 days of that declaration.
Interesting. So despite the profit dip, they're proposing to maintain a dividend payout. That's often seen as a positive signal, right?
It can be, yes. A sign of underlying confidence, perhaps, or a commitment to returning value to shareholders even in tougher times.
Now, digging deeper into the numbers, there was mention of an exceptional item. What was that about?
Yes, that was quite significant. A one-time income boost. They reported exceptional income of 1,838.02 crore for the year, both standalone and consolidated.
Over 1,800 crore. Where did that come from? Not normal operations, I assume.
No, not at all. It was basically due to winning some legal arguments, specifically related to value-added tax VAT input tax credit under the Gujarat VAT Act.
So a tax dispute went their way.
Essentially, yes. They got favorable orders from the Supreme Court and the Gujarat VAT Tribunal. This meant they could reverse a provision they'd previously set aside for this issue.
So money they thought they might have to pay out, they now don't, and it flows back to the profit line.
Exactly. It's a nice boost to the reported profit for the year, but you have to remember it's a one-off. It doesn't reflect the ongoing operational earning power.
Good point. A one-time gain. Now, another interesting item mentioned was the LPG buffer account. Sounds complex.
It is a bit complex, tied into government pricing policies. As of March 31st, 2025, IOCL had a cumulative negative buffer related to LPG cylinders amounting to a massive 19,926 crore.
Nearly 20,000 crore negative buffer. What does that mean?
Okay, so think about the price you pay for an LPG cylinder versus what it actually costs IOCL to get it to you. Sometimes the market price determined by the government, market determined price or MDP, is less than the effective cost to the customer, ECC.
So they're selling it for less than it costs them, effectively.
At certain times, yes. Back in April 2020, the Ministry of Petroleum and Natural Gas directed the oil marketing companies, like IOCL, to track this difference. When the MDP is lower than the ECC, it creates this negative buffer. Crucially, the revenue equivalent to this negative buffer hasn't been recognized in their accounts yet.
So it's like potential revenue they haven't booked because of the pricing structure, a kind of IOU from the pricing system.
That's a decent way to think about it. It represents a significant amount related to regulated pricing that's currently sitting off the main revenue line, impacting their reported financials. It highlights the complexities of operating in a regulated market.
Definitely adds a layer of complexity. Were there other disputes or uncertain financial items mentioned?
Yes, a couple worth noting. The Defense Accounts Department and the Indian Air Force have deducted payments, totaling around 621 crore and 69 crore, respectively.
Deducted? Why?
They're claiming price differentials on supplies made a couple of years back, between January 2022 and March 2023.
And IOCL's stance.
They're fighting it, contesting the claims directly and also through the Petroleum Ministry. So that's nearly 700 crore in disputed receivables right there. Adds a bit of uncertainty.
Money they believe they're owed, but haven't received. Okay. Anything else?
There was also a mention of a legal case in the Delhi High Court about a pension scheme for retired employees that was stopped retrospectively. There was a court order recently about recalculating pensions for some petitioners.
Could that cost them?
IOCL's current view is that no specific provision is needed right now because it relates to a separate superannuation benefits fund. But, these legal things can evolve. It's something to keep on the radar as a potential future financial consideration.
Got it. Okay, let's break down the business itself. How did the different segments perform during the year? Standalone results.
Right. Unsurprisingly, the giant segment is petroleum products. That brought in revenue of 7,093,370.63 crore. Huge number.
The core refining and marketing business.
Exactly. But interestingly, the petrochemical segment actually reported a loss for the year, about 440 crore.
A loss in petrochemicals, while the main petroleum business, despite lower margins, was still profitable. That's quite a contrast.
It is. It raises questions about what specific challenges that segment faced, maybe pricing, demand, feedstock costs. Something hit them hard.
Worth digging into later, perhaps. What about other segments?
The gas segment contributed significantly to revenue, 42,341.44 crore. And then there's other business activities, which brought in 1,747.14 crore. So petroleum products is the giant, gas is substantial, Petrochem was a drag this year, and other is smaller scale.
That gives a good picture of the different moving parts. And these results, they were just approved.
Yes, the board met on April 30th, 2025. They approved these financials and also recommended that dividend we talked about.
And the auditors, who signed off?
It wasn't just one firm. They had 4 joint independent auditors review the results. Mrs. Kanawal Jain & Co., Ms. KG Samani & Co., LLP, Mrs. MKPS & Associates, LLP, and Ms. Commodore & Co., LLP.
4 different firms. That certainly suggests a high level of scrutiny.
It definitely adds a layer of assurance having multiple independent eyes on the books.
Okay, we touched on the debt-to-equity ratio earlier, 0.75. Were there any other key financial ratios that jumped out from the standalone numbers?
Well, another one to look at is the current ratio. As of March 31st, 2025, it stood at 0.67 times.
Current ratio, 0.67. Remind us, what does that measure? Liquidity.
Exactly. It's a measure of short-term liquidity. It compares current assets, things like cash, receivables, inventory, to current liabilities, which are obligations due within a year.
And 0.67. That's below 1. What does that imply?
A ratio below 1 means that at that specific point in time, their current liability has slightly exceeded their current assets. It can suggest potential pressure on short-term cash flow or working capital management. It doesn't necessarily mean crisis, but it's an indicator of tighter liquidity compared to, say, a ratio above 1.
So something to keep an eye on, perhaps.
Definitely. And just to circle back to profitability, that net profit margin we talked about implicitly earlier, for the year ended March 2025, it was 1.53%.
1.53%. And how does that compare?
Down significantly from 4.57% in the previous year. So it really quantifies that profit squeeze we saw. They kept only about 1.5 paisa of profit for every rupee of revenue, compared to over 4.5 paisa the year before.
Right. That clearly shows the impact of those lower realigning margins. Okay, so putting it all together, this deep dive gives us a pretty clear snapshot of IOCL's performance and financial position for the last financial year, based on their reports.
Absolutely. It covers the key highlights, the profit drop, the GRM compression, the high operational throughput, the debt levels, the dividend, that exceptional gain, the LPG buffer issue.
The ongoing disputes, segment performance variations, and key ratios.
But it's also important to remember what isn't in these specific documents, right? Things an investor might still want to know.
Good point. Like what?
Well, for example, detailed capital expenditure plans for the next financial year, FY26. What are they planning to invest in? Also, more specifics on how they plan to tackle those government receivables beyond just the LPG buffer.
And the big one, probably, what's management's outlook on refining margins going forward into FY26? Are they expecting improvement?
Exactly. These are the kinds of forward-looking insights you'd typically hope to get from analyst calls or further management commentary, which aren't fully detailed in these backward-looking results documents.
Right. So for you listening, we hope this run-through has given you that clear, concise understanding of IOCL's recent results, hitting the key points without getting you bogged down. We really aim for those aha moments where the numbers start to tell a story.
And thinking about that story, considering that sharp drop in refining margins we saw and that big ongoing LPG buffer issue, perhaps a key question to ponder is, what do you see as the biggest challenges and maybe opportunities for IOCL in the year ahead?
That's a great question to leave you with. What stood out most to you from our discussion? What other questions does it spark? Because staying informed, really, it's an ongoing process of exploring and thinking critically.
Couldn't agree more.
Thanks for taking this deep dive into IOCL's financial results with us today.
Yes, thank you. We hope it's provided some valuable perspective on this major player in the Indian economy.